This is the final module of Lessee accounting and covers the presentation and disclosure requirements of IFRS 16 in the books of the lessee. We previously covered presentation indirectly in the previous modules, but let's recap. In the statement of financial position, a lessee recognizes a right of use asset, and this is a separate line item under non-current assets, the non-current asset section of the statement of financial position. The value at which that asset is carried is at its carrying amount, which we covered in the previous module. The second line item that a lessee will have on its statement of financial position for a lease agreement is the lease liability. This is also a separate line item, but remember, this is a financial instrument and thus broken into a non-current and current portion. Now this is important. The current portion will be the interest and lease payments that will accrue and be paid in the next 12 months. So remember, current, everything that is owed in the next 12 months. So based on your amortization schedule, you will take the sum of the interest that will be added to the liability in the next 12 months and deduct the total lease payments that will be made in the next 12 months. Alternatively, the current portion of the liability is the capital portion of the lease payments payable over the next 12 months. I will illustrate this further in an example. On the SPLOKY, the lessee will also have expenses relating to the lease agreement. The first one would be depreciation on the right of use asset. Now this is not a separate line item, but a sum of the depreciation of all depreciable assets of the entity. Remember, depreciation is relating to the right of use asset. Then also we said that variable payments that is linked to turnover, production, or anything else that is not an index or rate is not included in lease payments. And those parts of the lease payments are expensed when they are paid. And thus for those variable lease payments, there might be a line item included in the SPLOKY. This could also be aggregated into the other expenses line item and then split out in the profit before tax note. The third expense that will be included in the SPLOKY for a lease agreement is the finance cost on the lease liability in accordance with the effective interest rate method. So remember, this is also not a separate line item because the entity might have other finance costs. And so this is an aggregation of the net finance cost and income of the entity, but then it will be split out in the finance cost note. What is the finance cost that relates to the lease agreement? When we look at the disclosure, I always go back to understanding what is the purpose of the notes to the financial statements. Now remember, the notes are to provide the users of the financial statements with information and explanations about amounts on the face of the financial statements. So if we think about what line items are presented on the face of the financial statements, it would lead us to what notes should be included. So if IFRS 16 requires 4 notes under a separate section for leases within the notes. And if you think back to the previous slide, that makes sense. So we have one for a right of use asset, one for the lease liability, and those explain the line items on the statement of financial position. There is then one note that explains all the income and expense line items in the SPLOKI. So that is depreciation, variable lease expenses, finance costs. Then remember, we have 4 statements in a set of financial statements: the SPLOKI, the statement of financial position, the statement of changes in equity, and the statement of cash flows. Now, a leasing agreement would involve cash flows which would impact the statement of cash flows, and thus we would need a note explaining the outflows that relating to the lease. Please note that this is not within the assessment criteria for this module, so you don't need to worry about the note to the statement of cash flows. Now remember, we can't just have quantitative disclosures. We need to include other important qualitative information that will be helpful to the users to understand the activities and transactions of an entity. So IFRS 16 requires other qualitative disclosures, such as what lease agreements the entity has in place for the year or what did it enter into, any cash flows that are probably payable in future but are not included in the lease liability, so those that are based on judgment, and any covenants or restrictions that have been imposed by the lease agreement. So similar to any financing or liability like a bank loan, where they impose certain covenants, a lease agreement might also, because leases are a type of financing, there might be certain covenants or restrictions that the lessor places on the lessee, and that must be disclosed in the financial statements. This is an extract of each of the notes from the GAAP handbook. I'm not going to go through this in detail. Please work through the structure and content of these notes carefully. Something that I just want to point out to you, so if you look at the right of use asset note, right, the carrying amount, it's just the carrying amount that needs to be at the beginning of the year, the movement, and the carrying amount at the end of the year. There's no need to show the cost and the accumulated depreciation separately as you would have with an IAS 16 note. Then if you look at the lease liability note, these are the undiscounted cash flows for lease liabilities that need to be presented in these bands. Now remember, these bands will be provided to you, and these are the actual lease payments that the lessee will make to the lessor. So it's not the interest component, it's not the capital component, it is the actual lease payment that will be made. Let's work through class example 13. This follows on the Rocco Limited scenario that we have covered in examples 6 to 10. Please keep your workings from those examples with you as we work through this example. We are required to disclose the leases entered into by Rocco for the year ended 31 December 2017. We are given some additional information in the scenario regarding Rocco's leases. Rocco recognized lease expenses. Take note, the information says lease expenses, not lease installments or lease payments. It is what they have recognized in terms of IFRS 16. So these are all the IFRS 16 amounts in this SPLOKI, and thus the expense. So the following lease expenses were recognized. There were short-term leases for cell phones. The expense was 28,000 Rand for each of the years ended 31 December 2016 and 31 December 2017. The actual cash flows was also 28,000 Rand. Okay, so what do we have here? Remember, short-term leases qualify to be exempt from the general lease accounting requirements of IFRS 16 for the lessee, and they can be straight lined. So because the expense and the cash flows were equal to 28,000 Rand, this is the straight line amount. The second lease expense they had related to leases of office equipment, which were considered to be low value assets. Again, what should you be thinking about? Yes, low value asset leases also qualify to be exempt from the general lease requirements of IFRS 16 for the lessee, and straight lining is applicable. Okay, so for this office equipment, the lease expenses recognized was 10,000 Rand for each of the years, and we are told that the actual cash flows were 12,000 Rand. So remember, the straight line method ensures that the lease expense is equal over the lease term, and any over or underpayments are taken to the statement of financial position. The question also provides the time bands that ROCO uses for its lease liabilities. As I said in the previous slide, these time bands generally will be provided to you. Okay, so if we quickly recap on ROCO Limited's lease, besides the ones that were included in the additional information to this example, ROCO entered into a lease agreement to lease an office building on 1 January 2016. The lease payments were 2.4 million Rand per year, but included in those lease payments was 300,000 relating to maintenance expenses, and those maintenance, that 300,000 was considered the relevant standalone price. There was a residual value guarantee of 1 million Rand, and at commencement date of the lease, ROCO expected that 1 million Rand to be paid at the end of the 20 years. Okay, so if we start off with our notes, remember we said that there are 4 notes in the leases section of the statement of the notes to the financial statements. The first one relates to the right of use asset for the office building. So just important on disclosure here. So you do a right of use asset note per class of transaction, per class of asset. So this is for the office building. Because the question asks for the disclosure, presentation and disclosure as at 31 December 2017. Remember, in terms of the IS1, the conceptual framework, a set of financial statements always has a comparative, and the notes also includes that comparative. So that's why we have a 2017 column and we have a 2016 column. Right, so because this lease was entered into on 1 January 2016, so the carrying amount at the beginning of 2016 was nil. Then the additions is the initial cost of the right of use asset that we calculated of 16,539,498, and that was in example 7, the initial measurement of the right of use asset. The next is adjustments for the lease liability, any reassessments, and that, you remember, for the ROCO Limited scenario, we did not have any adjustments. We did that for Poly Limited. Then we have depreciation on the right of use asset, and that was pretty simple. There was no purchase option, or the asset does not transfer to ROCO at the end of the lease term. So we depreciated over the lease term of 20 years, and that we worked out in example 9 of 826,975. Remember, because there was no adjustments to the lease liability, and then which which impacted the right of use asset, the depreciation for 2017 was the same as 2016. That left us in 2016 with a carrying amount on the right of use asset of 15,712,523. Now that is the amount that will appear on the statement of the face of the statement of financial position, and also is the amount that starts off as the carrying amount at the beginning of the year of 2017. Following the exact same logic in 2017, we end up with a carrying amount at the end of the year of 14,885,548. And again, those are the amounts that appear as the line items, the right of use asset line item on the face of the statement of financial position. As I mentioned previously, just a reminder that you don't need to split out the carrying amount between cost and accumulated depreciation as in a normal asset PPE note in IAS 16. Then the next note that is applicable for this lease agreement is the lease liability. Now, if you can see on the left-hand side of this note, it's split out into in a maturity analysis. This maturity analysis was provided in the question. So they gave you the brackets that they want you to disclose it in, and this will be provided in the assessment or the exam. Now, if you look at this, in terms of this maturity analysis, you need to include your lease payments not later than 1 year, later than 1 year but not later than 5 years, and later than 5 years. But now this is for all lease payments in future. So what is a nice thing to do at the beginning when you're starting off this note is to work out how many years are still left on this lease. So remember, we started off this lease. This lease was 20 years and was started on 1 January 2016. So at the end of 2016, it will be 19 years left, and at the end of 2017, there will be 18 years left. So if we start off with the not later than 1 year, that is the lease payments that will be made for this lease in the next year, and this is only the lease payment relating to the lease component, the actual lease payment. Now remember, the lease installment was 2.4 million rand a year, but 300,000 rand of that related to maintenance expenses, which is a non-lease component. So the lease component installment was 2.1 million rand, and that is what is payable for the next year in 2016 and in 2017. This is the actual, the capital plus the interest. Now the next one is later than 1 year but not later than 5 years. What that actually means is the lease payments for 4 years. And that's quite simple. It's the 2.1 million multiplied by 4, which equals 8.4 million rand. Now, when we come to later than 5 years, you need to just work backwards to ensure how many years do you now have left. So for 2016, we said that at the end of 2016, there is a total of 19 years left for the lease agreement. We've used the 1 year, which was the 2.1 million, and then we've said another 4 years, which was the 8.4 million. So 19 minus 5 gives you 14 years. So 14 years multiplied by 2.1 million, right? That gives you the 29.4 million. But remember, lease payments, what is also included is lease payments payable during the lease term and at the end. And this Rocco, there was an estimated guaranteed residual value guarantee of $1 million, which at commencement date, Rocco estimated that full million will become payable. So the amount that will be payable in later than 5 years would be the 29.4 million plus that million, which would be 30.4 million rand. For 2017, the same logic applies. So you would say the 2.1 million multiplied by 13 years, because remember in 2017, the later than 5 year bucket will be 13 years plus the residual value guarantee. The third note that would be applicable for this module, remember we said the statement of cash flows note is not required. So the third note that is applicable here is the income and expenses relating to leases. Now, something that is very important to remember here is that you need to include everything related to all leases. And remember, we obtained additional information for this example relating to other leases that Rocco entered into. So on the first one is the depreciation, and remember you need to show the class of asset that it belongs to, and that is on an office building. So if there was other leases, for example, motor vehicles, office equipment, etc., we will show those separately. So depreciation, motor vehicles, depreciation, office equipment. Okay, so this one is pretty simple. The 826,975 that we worked out in example 9 and also disclosed on the right of use asset note in the previous slide. The next one is maintenance expenses. Now remember, this is the non-lease component that is expensed immediately when paid, and that is at the relevant standalone price. So the lease installment was 2.4 million, but 300,000 of that related to maintenance expenses, and that 300,000 was market related. So we will show it in this note as part of income and expenses relating to a lease. The next one is short-term leases. Now remember, in this example, they told us that there was short-term leases of 28,000 Rand, and that was the actual expense, the straight line amount. Okay, and take note of the narratives that have been disclosed here. The company has elected to apply the simplified accounting method for its short-term leases of computers, right? So remember, this is a election that the lessee can elect to make use of and doesn't have to follow the general lease accounting requirements. The next one, there was also low value assets for office furniture, and those were at 10,000 Rand. Remember, we said also that is the straight line amount. Again, take note of the narrative disclosure. The company has elected to apply the simplified accounting method for its low value leases of office furniture. Then the last thing that goes in this note is the finance costs related to lease liabilities, and this is in terms of the effective interest rate method. So in example 10, we drew up our amortization table, which showed us what was our interest that needed to be accounted for in the SPLOKI for each of the years 2016 and 2017. So if you go back to your amortization table of example 10, you will see in 2016 the interest component of the lease installment of 2.1 million was 1,894,740, and that was journalized to the SPLOKI, and in 2017 it was 1,870,109. So as you can see, this portion is really You've done all the calculations already. It's just plugging in the figures. Alright, so now we have completed everything relating to lessee accounting. You should now be familiar with all of the assessment criteria that is required for lessee accounting. I've also included the notes and the examples handouts as well as in the GAP handbook, and then the remainder of the homework questions that you would be able to now do for lessees.